Thank you all for joining today. We're going to kind of get the ball rolling. Anyone who joins late or needs to jump out early, you can use the same link to view the webinar after the fact on demand if you can't stay for the entire time. But we have a lot to chat about today. My name is John Pasalis, for those of you who don't know me, broker owner at Velocity Realty. Ermi Desai, our content editor, couldn't join us today. I have Gus Papaioannou, who's going to be joining me and chatting a little bit about some of the trends he's seeing on the ground. So please post your comments in the chat, either directly to me or you can post them publicly. It's up to you. And as I'm going through some of the things we're going to be talking about today, I'll keep an eye on that so I can kind of unpack anything that's not clear. So your questions are helpful, obviously, if I'm talking about stuff that isn't clear, because we have quite a bit to talk about. The market's quite volatile. There are a lot of things going on, and it's difficult to make sense of these trends. So we're going to chat a little bit about some of the dynamics we're seeing right now, and sort of this is a kind of a rough agenda of what we'll be talking about. We're going to look at the market for low-rise houses, look at the market for condominiums. Then I'm going to chat about sort of the fact that, sales that are record low in May are pretty much, and sort of some of the things we're thinking about that. I'm going to chat a little bit about a lot of comparisons people are making between today's market and the market in 2017, which kind of has very similar patterns. I'm going to try to unpack some of the differences that we should be mindful of when we're trying to make those comparisons. I'm going to chat a little bit about the low-rise or the suburban market for condominiums, and then, of course, answer any questions that I wasn't able to answer as we were going through the webinar. So let's just kind of get started right now. Just touch on the market for houses in the whole Greater Toronto area. So there's a low-rise, semi-detached, single-family homes, detached semis, row houses, and we can kind of see here in red, sales continue to trend down for 2022. I mean, this is not a typical trend as we move into the spring market. Usually sales increase from March to May. We've seen them down from March. March is the peak. They declined to April, and then again lower in May again. So well below 2019 volumes. Again, we don't want to make comparisons to 2020 and 2021 because 2020 was the lockdown in March, April, May. And then last year was just a crazy year that we can't really compare to. So 2019 is probably the more typical month where you can kind of see that light blue where sales are rising as we move into the spring market. And the number of new listings, and this is an important dynamic for the low-rise market, isn't surging. It's not particularly high. It's fine. It's below 2019 levels. But when we consider the fact that a lot of the listings coming on the market now are actually homes being listed multiple times because their original listing fails. A lot of times when agents can't sell it or they need to change the price, rather than, just reducing the price, they'll just cancel their original listing and then relist the home. So a lot of the new listings are actually just the same homes being recycled. So it's not all new inventory. So when we keep that in mind, new listing volume is actually relatively soft. So it's not that high, and that's one big difference from 2017. Active listings are increasing because demand is plummeting, not so much because new listing volume's surging. And I think that's an important thing to keep in mind. When we look at the months of available inventory, again, this is the most important metric because it shows us the balance between supply and demand. So the months of inventory is just if there are 10 homes available for sale at the end of the month and 5 homes sold that month, we would have the equivalent of 2 months of inventory because that's how long it would take for the remainder of those 10 homes to sell if we're selling 5 homes a month. So as the months of inventory increases, this is a sign that the market is cooling down. The more inventory we have, the slower the market. And it's interesting, I was just speaking with a friend the other day, and the way we see this is the way most people see it on the ground. He said to me, I could tell the market's changing. 2 months ago, all I would see are sold signs, and today all I see are for sale signs, right? And this is what happens when the inventory is increasing. It's taking longer for homes to sell. So inventory is increasing. I mean, it's technically still a quote unquote seller's market, but we're seeing a lot of downward pressure on prices because a lot of homeowners were pressured into selling their homes, and the number of homes selling for over asking is declining. But most importantly, the price for low-rise homes has declined, from just under 1.7 million, in February to, closer to like mid 1.4 range this month. And again, this is happening because a lot of people who bought in February, March went to go list their home. Market was a lot slower than they anticipated. And, every week sellers are taking maybe 20 grand less than what the neighbors sold for the week before. But if every neighbor is doing that for 8 weeks, all of a sudden prices are down $200,000 in 2 months. And this is kind of what's happening. And I didn't post any weekly stats for this webinar, but I can tell you what I'm starting to see, at least, and I'll see what this week's numbers look like, is we're starting to see a little bit of stability in prices, almost like, low-rise prices are plateauing at like 1.4-ish for a few weeks in a row. Like since I think March, they've been kind of declining every week. And I think part of this is partly because a lot of those distressed sellers have sold, and a lot of the listings that are coming up right now, even like our clients, are people who don't need to sell. They're selling first and then buying a home, and those sellers are going to be a lot more patient than someone who's already committed to buying a home. So when we look at the condo market, we see similar trends. So sales again are declining for condominiums. Since March, they've been trending down. New listings, however, are actually quite high. I mean, if we compare to compared to last year, and last year was a very strong year for listing volumes. But if we look at this and compare it to 2019 in the light blue, listings are quite strong for condominiums. And this is helping push active listings higher and has actually pushed the months of inventory for condominiums higher than it is for low-rise homes. I mean, for condominiums, we're about 2.5 months of inventory. Low-rise homes, we're at about 2 months. Number of homes selling for over asking is plummeting. Now, condo prices have declined a little bit. They've started to, not quite as much as home prices, and largely because I think, again, a lot of the sellers of condominiums are probably a lot of investors who, they're not like the low-rise homeowners who bought a home and need to sell and are pressured to sell. So those sellers are a little bit more sticky on their price, but we're actually seeing inventory increase for condominiums a lot more than we're seeing for low-rise homes. So we could see some pressure on the condo prices. I'm going to be launching a series of videos over the next few weeks or so that focuses on how to make smarter real estate decisions when prices are falling, both as buyers and sellers, because I think it's a very difficult time to navigate this market. Obviously a lot of buyers want to know, when should I buy? When should I wait? Should we wait a little bit longer? And similarly, sellers want to know if they should list now, if they should wait, if things are going to recover and when. And it's obviously a lot of different considerations. So I'm going to try to unpack these in a bunch of videos over the next few weeks or so you can keep an eye out for those. For those of anyone who's like actively in the market, and looking for advice or feedback, you can basically, feel free to reach out to me. I'll add a link here to a page that you can sign up for a consultation if anyone has any questions about the market and the market dynamics right now, and wanted some more personal advice that we're not going to kind of cover today. So I don't know if Gus, are you still there? We can kind of chat a little bit about some of the trends that you're seeing kind of on the ground as well.
Yep. Hi, everybody. Can you hear me okay?
Yep. Perfect. So maybe some of the things that you're seeing kind of on the listing side, on the buying side, in the market right now.
Yeah, for sure. I mean, I've been tracking kind of different areas over the last month, and even like a month ago, I was, talking about how certain pockets of Toronto were still kind of holding up okay. The Riverdales, the Leslievilles, the Leasides, the High Parks. These are prime neighborhoods with high demand, and we weren't seeing. Yes, bidding wars were lower. Yes, viewings were lower, but they were still. Properties were moving fairly quickly still. Well, 1 month later now, it's like, and you've been talking about it, we've been watching it, it's kind of flipped, and to the point where in the last couple of weeks, I've met with or spoken with 3 different sellers who are trying to sell their properties and can't. They're having a tough time and they're looking for second opinions, and they've already purchased. So,
Yeah.
that's really hard to hear, but it's now happening, and it's a couple of those people were one is in Yorkville, the other one's down in Leslieville. So it's happening, starting to happen in those neighborhoods. Definitely showings are low. Definitely buyer demand is very quiet. Even the buyers that I'm working with, I don't blame them. They're being super, super patient. And I feel like buyers they want more now. They're seeing prices kind of fall and a lot more selection. So they're trying to get more for their money. And again, I don't blame them. So they're being a lot more patient. And obviously, rates have taken out a lot of other buyers and probably quite a few investors. So that's really taken down a lot of the demand. But in terms of the selling side, again, depending on the property, how well it's staged, how well it's presented, if you're a patient seller and if you haven't purchased yet, and then you put your property on the market to sell first before you buy, you just need to understand you need to be patient. It's no longer 1 week and you sell. It's 3 weeks, 4 weeks, 6 weeks, and because the amount of showings have gone from, we used to get 30 in a week, whereas now it might take 6 to 8 weeks to get 30 showings, if you can even get 30 in that time frame.
Yeah, and that's a massive turnaround. I mean, I think that's the disconnect from what we see from what other versus what sort of people who are not as active in this business. When you're listing homes for sale and you only have 3 showings, I mean, as a seller, if you've bought a home already, you're panicking in that. Like it's very stressful. And I mean, to echo sort of what you're finding, I'm certainly finding the slowdown has moved to the core downtown a little bit. I mean, it's not quite as significant as the suburbs. I mean, we just had a client, I think it was Maria. I mean, we were going to talk about it in our sales meeting, but, she had a client who just basically put in an offer a month ago on a home in Leslieville that was holding back offers. They got no offers. Our clients went in, I think, for at $1,050,000, which was a reasonable price. We felt the sellers thought that was too low. I think they were expecting 1.1. So they just canceled their listing. And literally, I mean, this week, I think a month later, they contacted and reached back out and said, okay, listen, we would be open to $1,050,000 now, right? But the problem was, we looked at the comparables and we said to our clients, and we said, $1,050,000 is too much now. Like, if you just look at a few sales that have happened in the past 2 weeks, that's too high a price. Like, I wouldn't go over $1 million, right? And the clients agreed, and we reached out to the sellers and said, listen, we're not paying $1,050,000. I mean, you lost your opportunity. We'll offer $1 million, and they're not interested now. And I felt like saying, if you wait any longer, it might be $950,000 in 6 weeks. But, and listen, someone might be saying, well, why the heck are the clients that we have, want to buy? I mean, at the end of the day, they're first-time buyers. They're renting. They don't need to sell anything. They're not trying to time the market. But they're certainly more patient. They're not like, they don't feel desperate to jump in on this. And even they feel like if they wait a little bit longer, might they get a little bit more for their home. And yes, they're going to pay higher interest rates, but over the long term, they're at least going to have a 3-bedroom home instead of a 2-bedroom home. So definitely still seeing a slowdown in the downtown core as well as in the suburbs. And I don't know if you had anything else you wanted to add, Gus.
No, just to add to that, I mean, exactly what you just pointed out. I have a client who's been looking at Newmarket for months and being super patient, and they're first-time home buyers, and their budget is in the 800 range, and there was absolutely zero available. It was like every time something came up, it was getting a bidding war and selling over 800. Now, all of a sudden, they have selection, and they've gone from a 2-bedroom to a 3-bedroom. So I don't blame buyers for being patient. It's just a matter of now, like, focusing on what you really want and seeing if you can get a value, get your value buy and get the home that's gonna kind of you're gonna stay in long term. But yeah.
And we had a question about our prediction for when it's going to be in a buyer's market. We are in a buyer's market. Like, it's not, forget the statistics. Like I said, the chart people are like, well, it's still a seller's market because it's 2 months of inventory. You can't listen to that stuff. And I have a lot of agents trolling me on Twitter and getting angry because I'm talking about how the market's slowing down, and they're trying to tell me I'm wrong because it's 2 months of inventory to seller's market. And I'm like, you're not reading the numbers right. It's a buyer's market right now. I mean, there are very few showings. There's still some sellers who are desperate. Not all are. This is one of the challenges with navigating this market. Like, and I've talked about this in a past webinar. Like, we have clients who are considering 2 or 3 homes. You don't know which one of those sellers are going to be the desperate seller who takes a price even below current market value because they need to sell, and which one is the more patient seller. But it's certainly a seller's or a buyer's market right now. And I suspect it's going to continue to be one well into the fall market.
It is. I agree. I mean, and an example to the data and what you just mentioned, I had a client in Yorkville who, someone I met with in Yorkville that has having trouble selling their condo. And back when the last couple comps sold in January, there were maybe a couple other listings in the entire area of similar type product. I happened to look it up for them today before we met, and it's like 26 other units that are very similar in a similar price point available now. So, I mean, yes, inventory is low as a whole, but it's come up so dramatically and then the buyer demand has dropped so much, gone the other direction, that it definitely feels like, although the numbers stayed 2 months worth of inventory, when you're out there, it feels like we got 6 months worth of inventory, and it's definitely a buyer's market.
Yeah, 100%. And that's largely because there are so few showings out there, right?
Yeah.
Would I do a video? Would I do? So the question is, would I do a video or talk about what to consider when hiring a real estate agent? I would imagine the criteria may be different for buyer and seller. Yeah, 100%. And like I mentioned, I think I mentioned, like, some of the videos that I'm looking at releasing over the next few weeks or so talk about the things that buyers and sellers needs to be considering in a slowing market. And quite frankly, like, whoever you hire needs to be thinking about these things as well. We just had a buyers reach out to us, and basically, they fired their agent. And I said, well, why'd you fire your agent? Why'd you come to us? And they basically said, well, because every time we would, bid on a home, the agent would say either the home is worth whatever you're willing to pay for it, or the price is just going to be higher tomorrow, or there's no comparables for this property. And all of those are terrible answers when you're spending a lot of money to bid on a property. So, if you're a buyer, you need someone who's educating you about market value, current conditions, and also understanding, is this a neighborhood or area where the momentum's slowing down? Should I pause a little bit, or is there a little bit of stability in the market? And in most areas right now, probably it's still sluggish, but I don't know. It's tough to answer. There are a lot of considerations, and certainly I do a video specifically on what's to consider when you're working with sellers. So I'll post those on our YouTube channel. I'll share them on Twitter over the next few weeks or so. Another question
from D. Thanks for today. Yeah, no, I'll read it to you. Would you be great to hear about porting your mortgage when it's a fixed and adding on the variable rate? Also, what are your thoughts about tenanted properties in the suburbs, 905, given rate hikes?
So porting your mortgage, I mean, again, I think you'd want to talk to your mortgage broker. Certainly most mortgages you could port, but if you need to add, if you're taking on an additional component, I mean, certainly some lenders will allow you to just add, say, a $300,000 additional portion that's variable. So split the fixed and variable. So that's an option. I mean, tenanted property. So the rental market is booming right now, and that's certainly, if you own a rental property, that's great. The challenge is going to be anyone who owns rental properties who has to renew a mortgage in the next year or so is going to get hammered, because you're going to be paying much higher interest rates than people were a year or two ago. So I think the numbers are going to be pretty hard unless you have a ton of equity in the property. But the rental market's tight, and if you're a landlord, you should be patient and make sure you're hiring or leasing it out to a good tenant.
Hossein says, even though sellers are now more patient and plan to sell first and buy later, don't you find it likely a larger inventory day by day would soon push prices to go lower? I think it's more about accepting a new reality, higher borrowing costs versus being patient. What's your take?
Yeah, that's a great question. And I posted that on Twitter. So and this is going to depend on, so where prices are in the fall, like demand's going to decline a lot because of higher rates. if prices fall, it's going to depend on sellers and how many of them list and how motivated they are. Like typically, sellers are stubborn and are reluctant to lower their price. Like sellers would rather wait 4 months to get what their neighbor sold for last week than reduce their price, right? And that's why, like, if you read a lot of like historical housing market, like the prices they say are often sticky on the way down, and that's what they mean. That's basically sellers are stubborn. The reason they weren't sticky in Toronto right now is not because the sellers aren't stubborn, it's because they're basically distressed. Because Toronto's a bit unique. In most markets, people don't rush out and buy a home and then sell their home. Most people sell their home, get everything organized, and then look and buy a home, right? They're not distressed on the sale. Toronto's completely different, and that's why prices fell so rapidly. And yes, to your point, if inventory picks up, we could see some downward pressure. But again, I think it depends on how many listings and how eager those people are. So we don't know, but for sure, we could see some more downward pressure on prices from sellers who just, like you say, there's always going to be those sellers who just want to move on and are not going to wait 3 months, and they just are accepting the new reality. Awesome. All right, Gus, thank you so much for joining. I'm going to move on and cover the rest of the topics, unless you had anything else to jump in on.
No, I'm good. Okay, thanks. Beautiful. Thanks for having me.
Thank you. All right, so we're going to go on to real estate sales. I'm just going to touch on hitting a 20-year low, and I already touched on this already. This is a chart for the number of homes that have sold in the month of May. And you'll see that aside from the dip in 2020 because of the lockdowns, last month was the lowest in basically 20 years. So, and it's really interesting that it's so low because, when we think about how monetary policy and changes to the Bank of Canada's policy rate impact the housing market, the Bank of Canada says it takes anywhere from 18 to 20 months for the economy to really feel the effects of higher rates. And we're like 2 months in, and we're at a 20-year low in sales volumes, right? And it's completely different. And a lot of this, and I posted this on Twitter, is really just the fact that it's a lot harder to qualify for a mortgage. And rates, people were getting 5-year mortgage rates at 1.5% a year ago. Today, basically, like mortgage rates are going up above 5%. What that means is for every $100,000 of debt a year ago, your mortgage payment was $400. Today, every $100,000 of debt, your mortgage payment is $600. So that's like a 50% increase in your carrying costs. And that is having a massive impact on affordability, because affordability in the housing market is a function of not just home prices, but also interest rates, because that determines what your mortgage payment is going to be. So now we're in this environment where not only are home prices very high, we have very high interest rates. And that is really what's crushing home buyer demand in the short term and probably as we move into the fall market. So is the markets today repeating what we saw in 2017? Now, for those of you who aren't familiar with what happened in 2017, I'll say, well, in 2015 and 2016, the GTA saw this rapid boom in prices, primarily in the suburbs. We had it effectively like a small bubble, and prices peaked in the first quarter of 2017. And then they basically fell about 20% in 4 months just after the province of Ontario introduced the foreign buyers tax. And what happened is this spooked everybody because Vancouver or BC had done something similar and prices fell there. So as soon as Ontario announced that they were going to do that, sellers flooded the market because they wanted to sort of sell at the peak. Buyers pulled out of the market because they didn't want to buy at the peak. Then the market basically froze. And in many ways, it is very similar. We had a lot of sellers on the market who bought homes at the peak. They needed to sell, so they were distressed sellers, and that's why prices fell very rapidly. But and this is a sort of a chart in red of weekly sales for low-rise homes, and we can kind of see how sales have been trending down since March. And more importantly, I mean, look at prices. Prices have been trending down since February, actually. I think I said March earlier. Virtually every week, they've been kind of this line down because of this sort of these distressed sellers. So in many ways, there are similarities to 2017, but there are three huge differences. And those differences are high inflation, rapidly rising interest rates, and of course, high leverage. I mean, and when we think about, let me unpack each of these. I mean, at a high level, I mean, high inflation is what we're seeing in the market today. We're seeing the headlines, and this is just really all of the things that we consume are getting more and more expensive. I mean, gas, food, all of these things. And this is problematic economically for an economy because, of course, it impacts households who are on fixed incomes because every paycheck they get can now, they can buy fewer and fewer things. But it's also a massive problem for the economy because businesses, it creates a lot of uncertainty, a lot of, I have a friend of mine who's in the construction business, and he basically kind of installs windows for high-rise and mid-rise buildings. And he basically said that they're getting killed today because the project they quoted on a year and a half or 2 years ago, in some ways are low because all of their costs have increased. So right now, when we're pricing in projects for a year and a half or 2 years out, they're assuming prices will keep rising 7+% per year. So when you have an environment where people just expect prices to rise, it almost becomes a self-fulfilling prophecy. It creates a lot of uncertainty for businesses because it's harder to budget. So businesses sometimes are more reluctant to invest. And this is why the Bank of Canada is trying to kill inflation. I mean, if you read the headlines, the Bank of Canada basically says, I mean, this is their mandate. They got to keep inflation in and around 2%, between 1% and 3%. And the way they do that, and their main policy tool is interest rates. I mean, the only thing that they can really do is change interest rates. And the way interest rates impact inflation, I mean, if we think about inflation, it's really just like a supply-demand imbalance. There's just too many people chasing too few goods, which is driving the price up. So the Bank of Canada can't do anything on the supply side. They can't create more oil. They can't create more food. They can't do anything like that. But what they can do is reduce demand. And that's really what high interest rates do. So if you think about the family that was going to take out money from their home equity line of credit to do a $100,000 renovation or $200,000 renovation, well, if all of a sudden they're paying a much higher interest rate, 5% on that loan versus 1.5% or 2%, they may think twice about doing it. So it pauses that type of spending and that type of consumption. So when you take demand out, that hopefully eases prices and price growth a little bit. And this is really one of the main things they're doing to obviously cool inflation. Of course, some of the things they can't control, like these global, obviously factors like the war in Ukraine, and that's going to have a weigh on the economy because obviously the longer that goes on, the more we're going to have pressure on both food costs and oil prices. So there's certain things that the Bank of Canada can and can't do. And finally, the last big difference today is of course high leverage, and households are far more leveraged today than they were in 2017. Now, how does this all impact in sort of what's the difference between 5 years ago and today? Well, the big differences are, of course, like we kind of talked about, high inflation is weighing on households, and the longer we see the Bank of Canada keep interest rates high, it's going to make it harder for people to buy homes, which is going to affect our housing market. But also it's going to potentially, and that's going to cool demand. And this is going to be the first thing to keep in mind. This is sort of the first level effect. Like in the fall, we're going to see a dramatic decline in demand. What happens to price is going to be a function of sellers. But if the high rates stay with us, and the economy remains sluggish, and especially if we see job losses, and we're starting to hear about companies cutting jobs into the new year, well, this is where high levels of debt can really weigh on those households because they're going to start feeling the impact of paying 5% on their mortgage rather than 1.5% or 2%. And there are a lot of households over the past year or two who bought homes from lenders that basically only give 1 or 2 year term mortgages. So every couple of years you need to renew. And those households are going to see their mortgage payments go up 50% because, they probably got a 2% mortgage rate and now we're probably going to be stuck with a 4.5% or 5% mortgage rate. So all of these factors are what make this kind of this period we're in today very, very different from 2017. 2017, the economic conditions were fine. There wasn't a lot of risk in the economy. It was really just like a short-term housing shock that we had. Everything else was fine. Whereas today, we're seeing a lot more risk in the economy, largely because of high inflation. So we got one question that said, how about Bank of Canada stops printing money in order to cool inflation? Why are they using only the interest rates to cool inflation? So when we talk about kind of the Bank of Canada, this idea of them printing money, I mean, it's effectively kind of what they were doing is effectively the Bank of Canada was financing the government's deep borrowing during the recession, and this is something called quantitative easing, when the Bank of Canada effectively goes out and buys debt to drive interest rates lower. And I think they've I think they've actually killed that, or they substantially scaled that back. So the Bank of Canada is kind of, and most central banks around the world have significantly scaled back quantitative easing. So they're not having that additional effect on interest rates right now. I had one additional question. In 2017 for freehold, we have 240% active listings increase from June to March. However, this year we only have 40% listings increase, which with such low inventory increase, why have you seen such a big price drop? Do we expect the price to flatten out or keep falling in the fall with current listings? And that's a great point. I mean, it is true that in 2017 we saw a much bigger surge in listings and in months of inventory and all of those things. So why are we seeing such a big decline today? I think it's hard to explain the differences. Basically, it's hard to say why there's such a big difference. But at the end of the day, we still have a lot of distressed sellers, and we're still seeing prices plateauing right now, and we don't know how long that's going to last into the fall market. So it's hard to draw those comparisons 100%. One last comment: they're doing quantitative tightening right now, which is 100%, which is the opposite of trying to affect long-term interest rates. So that is certainly, and this is exactly the point. When the Bank of Canada uses policies like quantitative easing, they're trying to influence long-term interest rates, and they've stopped doing that, which is why 5-year mortgage rates have exploded. I mean, which is why we're talking about 5-year mortgage rates in the mid 5.5% range right now, because they're tightening, and these are all of the factors that are basically kind of impacting the housing market right now. It's not just the Bank of Canada's policy rate, but the fact that we're actually seeing 5-year bond yields surge, which is impacting 5-year mortgage rates. So yeah, thank you, Rita, for that comment. And again, touching on earlier, and I kind of touched on this earlier, the big impact today and why it's going to be a big issue in the fall is that a year ago, and how high rates are impacting us. You can get a mortgage for under 2%. Today, it's over 5%. And the stress test, even a few months ago, was 5.25%. If you're getting a 5-year mortgage rate, it's going to be over 7%, probably by next week. And by next month, when the Bank of Canada increases their policy rate, even variable rate mortgage stress tests are probably going to be in the 6% range. So all of this is weighing on the market. And I kind of jumped ahead and said I think those are the things that are going to weigh on the market. It's the fact that demand is going to plummet significantly. And again, I think when we talk about big declines in prices from here, we would need to see probably some distressed sellers or desperate sellers to see a rapid decline. And we don't know to what extent that's going to happen, but we're certainly going to see a big decline in demand. And again, what do we expect for 2023? And I think this is where I think it's the challenging part, where I think there's actually in some ways more risk, because it's in 2023 we're going to see if inflation's staying with us and high rates are staying with us, and if the recession that a lot of economists are predicting is with us, because it's a combination of recessions, job losses, high leverage, and high rates that can create a lot of instability in housing markets. And we're not there yet, but we have a lot of the ingredients that we might get there. Most economists, interestingly enough, are very optimistic that we're going to get through this. And most economists are predicting anywhere from a 15 to 20% decline in average prices nationally, which of course means in some areas it might be higher or lower. So they're not expecting a big correction. But again, I mean, I don't know how they come to these conclusions. We're going to have to see. It's impossible to predict, because if these factors weigh on the economy and we see job losses in the new year, that's going to have a significant impact. We have a question: if the Bank of Canada keeps increasing rates, won't the economy slowly contract and possibly head into recession? 100%. If this happens, will the Bank of Canada start to lower rates? Maybe Bank of Canada is increasing rates now so they can cut rates in the near future. This is a great question. I mean, so yes, the Bank of Canada wants to increase rates potentially to 3%. If that triggers a recession, I mean, do they lower rates to stimulate the economy, which is what they typically do. And my instinct is, if high inflation looks like it's staying there and not slowing down, I don't think they are, and at least from what they've communicated, they probably are not, because their primary mandate is getting inflation under control. If we start to see inflation ease, do they cut a quarter point or something like that? Certainly, but I don't think the Bank of Canada is going to lower rates to practically zero again to stimulate the economy if inflation is still as high as it is. So, and I think that's what kind of is the challenging thing to sort of understand where the market's going, because there's so many moving pieces that are impossible to predict, and how the Bank of Canada is going to respond to them. Next question: how do I think the Bank of Canada will go with how high do I think they'll go? So I think, again, I think the consensus was originally 2.5% for a while, and now it's almost like 3%. I have a feeling probably somewhere in that range, 2.5 or 3%, at least for this year. And I don't know if they're on autopilot. They might wait there and see what happens over the next little while. But they'll probably hit close to 3%. I mean, we're at 1.5 now. They're probably going to do 3/4 in July, which is going to push us to the low 2% range. And I would not be surprised if they do at least one other or two other hikes by the end of the year. So we're probably going to be close to that 3% range by the end of this year, which is going to have a massive impact on mortgage rates and, of course, on the housing market. So I'm just going to wrap up by briefly chatting a little bit about the suburban condo market, because it's kind of, a lot of people haven't really looked at it as much. It kind of hasn't made the headlines. Usually it's been about the low-rise market. But this chart shows the average or median sale price for condominiums. In dark blue is February 2020, just before COVID. In light blue is February 2022, which is roughly the peak. And what we can see is before COVID, Toronto condo prices were higher than all the other regions. And now post-COVID, Toronto's lower. I say we because I live downtown. Toronto's lower than York, Peel, and Halton. And Durham is just below Toronto. So prices have exploded. And when we look at the year-over-year change in 2 years, condo prices in the city of Toronto went up around 17, 18%. In York and Peel, 40+%, Halton 50+%, and 69% in Durham. And then when we look at how prices have changed since between February and May of this year, we're seeing a very similar trend where condo prices in downtown Toronto have not declined as much as they have in the suburban markets. And this is really mirroring what we saw in the low-rise market. So I hope, I don't know if we have any other questions. If inflation, we have one more. If inflation doesn't ease, I don't see the Bank of Canada reversing rates, but do you see the government increasing amortization period, or maybe OSFI lowering the stress test? So that's actually very good question. So, and my feeling is, so effectively, I guess the question is, if the inflation stays high and the bank can't lower interest rates and the housing market's declining, is the federal government or our banking regulator going to do something to try to stimulate the housing market? My instinct is they'll try to do something. So OSFI, which is our banking regulator, they've already said they're going to make some tweaks to the stress test. So we don't know what those are. But one of the problems with it now is because of the difference between the stress. So if you've got a 5-year mortgage, the stress test today is going to be probably close to 7%. Whereas if you get a variable rate mortgage, it's basically just 5.25% effectively right now, just because of the way the stress test rules are. That's basically the greater, and anyways, without getting into the details, it's basically pushing a lot of people into the variable rate market for now. And I think OSFI wants to change that pattern. So they might make changes to that. And similarly, the federal government might make changes to kind of ease affordability. And like, what could they do to ease affordability? Potentially, and I hinted this, maybe they increase amortization periods. Instead of spreading your payments out over 25 years, they do it over 30 or 35 or 40. And the federal government had done that back in, I think it's 2006 or 2007. And this would effectively counteract the combination of high prices and high interest rates, which is weighing on affordability. I don't know if they're going to do that anytime soon. I think we're going to have to see what the market looks like this fall. And if things aren't going great for housing, they might do that. But I think it's, again, I would be reluctant to assume that this is going to save the housing market, because at the end of the day, I think it's still going to be a sluggish market. Even if they do that, it might bring a marginal number of buyers in. It's not going to, I don't think it's going to result in a massive rebound in prices surging again. Because again, I think some households are going to be reluctant to take on a lot of debt. And more importantly, when the mood of the market shifts from optimism to pessimism, it's hard to get people to jump back in the market when prices are falling. It doesn't matter how much money you give them or how much debt you give them, right? And I think it's going to be hard for policymakers to counteract those trends if we're seeing downward pressure on prices. So I think they probably will at some point, whether it's later this year or early in the new year. But it's anyone's guess how effective those types of policies would be if the market's slowing. Do we expect and policy induced to stimulate the market, at least for the transaction count, for example? I'm not sure if I get it. Do we expect a policy to induce or stimulate the market? I mean, I think you're asking if these types of policies will stimulate the market. Like I said, to some extent, they might a little bit, add a little bit more demand. But again, I think that the biggest battle that policymakers are going to have is probably just, if prices are softening, the market sentiment changes, and it's hard to turn that when we go from optimistic to pessimistic. So even if you give people more debt, they're going to be reluctant to buy in what they think is, or take on more debt in what they think is going to be a falling market, right? So I think that's going to be a very challenging thing for the policymakers. I had a question: why is the Bank of Canada not pausing a bit and see if the current hikes are working on cooling inflation? Because inflation's out of control. They actually expect inflation to be higher in the next few months, and they're basically trying to do. They're doing everything they can to show, I guess, the public and businesses that they're trying to kill inflation. They've effectively said they'd be fine with a recession, even, if that means killing inflation. And to some extent, they're right. I mean, this is probably one of the biggest factors that's going to weigh on economy, because like I said, it creates so much uncertainty. It impacts households. It's like, so they're doing everything they can and are willing to kind of sacrifice housing effectively, which is very problematic, because, and a lot of what I said in my reports was really, I think it's been terrible that the Bank of Canada encouraged people to max out on debt, promising rates would be low for a very long time, when they obviously couldn't keep those promises. I mean, at the time, they should have known it's impossible to commit to keeping rates that low for as long as they thought they would. But and not that we could predict where inflation's going, but it's, they effectively did try to predict that inflation is not going to be an issue for a few years. So, and they were unfortunately wrong about that. So I hope that was helpful today. I don't know if you have any additional questions. If you do, feel free to send me an email at askjohn@movesmartly.com. And we'll see you all next month's webinar. Thanks so much again for your questions and for joining.